Now, let's try to understand the mechanics of the options market. As a part of this session, we are going to primarily cover on a broad note the different types of options, the option positions where we are looking at call option as well as put option. We will look at the position and the payoff for a buy and a sell, which are otherwise called as long and short kind of positions. What are the different kinds of underlying assets associated with options? The key specifications that go with the stock option, just like the way we have looked at the specifications associated with futures. Then some important aspects regarding the trading of options. We will look at the margin requirements. What is the margin that needs to be deposited by the long positions as well as the short positions? Then more or less different kinds of options, or probably a much wider world of options, or various instruments which have option like features like the warrants, employee stock options, convertible bonds, and other convertible securities, which have the characteristics of options. And towards the end, we'll just have a quick understanding of the over the counter option markets. So, quickly to look at the introduction part. So, options are different from forwards and futures. We know that. Because in forwards and futures, when two parties are getting into an agreement, both the parties have to adhere to the contract. They cannot really default on the agreement, default on the contract. Whereas in case of options, we know that it is giving a right but not the obligation to do something in future, to buy or sell something in future. So it is giving a right, not the obligation. Whereas in forward and futures, both the parties have a commitment. Both of them have to adhere to the contract. Whereas in an option, whosoever holds the option, this person may hold have the option or this party may have the option. One of the parties out of these two, who is called as the holder of the option, he will get the right whether to exercise that option or expire it. Right? So that is what differentiates an option from the other kinds of derivative contracts. And on the other side, in when we are talking about a forward or a future, there is nothing that is paid from one party to the other party on the day zero. There is nothing that is paid from one party to the other party on day zero of the contract, except for margin or collateral, which is more like a security deposit. It's not a cash flow that is paid from one party to the other party. So, I mean, we should not consider the margin and the collateral. Whereas in case of option, the party who has taken that right, who is the holder of that option, is explicitly paying an upfront premium to the other party, and it is non-refundable. It's not a security deposit. It's a non-refundable element altogether. So that's what differentiate options position from the forwards and the futures position, right? Now we know that there are two major types of options. So let's say A and B have got into a contract. A is the buyer. A wants to buy something at a future date. B wants to sell something at a future date. And we said in an option, any one of the parties can hold the option, can take the option, and the other party is called as the writer of the option. So here, if A is the owner or the holder of the option, B is called as the writer of the option. If B is called the owner of the option, probably let me look at A as the writer of the option. Now, in a role of the asset, With respect to the asset, A wants to buy the asset in future, B wants to sell the asset in future. Now, if the buyer of the asset takes the option, we call it as a call option. If the seller of the asset takes the option, we call it as a put option. Now, what is the option for him? Because he is acting in the role of a buyer of the asset, he has the right to buy the asset at a future date for a future price. If he really wants to buy it, he will buy for that price. If he thinks no, it is not worth buying, he can very well back out of the contract. There is no obligation for him to buy from B. Same way, if B has taken the option, we call it as a put option, and this option will give him the right to sell, not the obligation to sell. If he really wants to sell it on that expiration date or on the maturity date, he can sell the asset. If he does not want to sell it, he can very well back out. But in case he wants to sell it, it is obligation of A to buy it. So that is a basic terminology involved in the call option and the put option. And every option, whether it is call or put, there is an expiration date or the maturity date that is specified in the contract. So that is the date on which either the right would be exercised or expired. Similarly, exercise price or strike price talks about the price at which the option holder can buy or sell the asset on that expiration date. Now this is where two major kinds of options are available. American option, if I say this is today, this is the expiration date. If I can think of exercising any time between these two dates, the option holder will have the right to exercise any time between these two dates. He can think whether he wants to go ahead or exit. Any time between these two dates, those kind of options are called American options. But if the exercising can happen only on the last date, not anywhere in the middle, it can happen only on the expiration date, those kind of options are treated as European option. And because there is only one date on which the exercise or expiry happens, they are comparatively easier to analyze. There are some straightforward models that are available. The traditional Black-Scholes model for option pricing is having more and more applicability to European options only. Now, regarding some important points associated with the call and the put option, it's always that any party who has purchased the call option, he will expect that the stock price will increase, because call option is giving a right to buy an asset at an exercise price. Let's say here in this example, the exercise price is 100. Right? So A and B, let's say, have got into a deal that A will buy something from B at 100 bucks at a future date. Now, if the market price at a future date is 90, obviously A will not buy it from B at 100. He will expire it. He says that in the market it is available at 90. Why should I buy it from you at 100? So he will not exercise that option. But if the market price is, let's say, 105, yes, he can think of exercising that option because he can buy from that option at 100 itself. So generally it is like A will exercise the option only when the market price is above 100. The moment the market price is below 100, he will not exercise it, which means the person who has purchased the call option, he will always expect that the price will increase in future. The same logic if I put in case of a put option, he is selling it at a fixed price and he can decide whether to sell it or not. So if the market price is much lesser than that strike price, that is when the holder of the put option will decide to exercise the option, otherwise he will expire it. And when he is expiring it, you could clearly see that it is the premium amount that is lost. So because to take that option, a $5 premium might have been paid, and because of that payment of that premium which is non-refundable, if that option is expired, then the purchaser of the call option is losing that much amount. Here also the purchaser of the put option is losing that much of amount. So a general logic is, in case of call option, the holder will always exercise it the moment the stock price is greater than the exercise price. In case of the put option, the holder will always exercise if the stock price is less than the exercise price. So this can be taken as a very general rule, very much applicable in almost all the cases. Then just looking at the positions and the payoffs. As we have said, if I ignore the premium, right? So we are talking about four important positions. This I am calling it as a long call. This I call it as a short call. This is a long put and a short put. Now you see a person who has purchased a call option. Ignore the premium. If I take in the premium, it's just a parallel. Right? So if I ignore the premium, right, until let's say this is the strike price. So if the market price is below the strike price, the option will be expired. If the market price is above the strike price, the difference between the market price and the strike price is going to be the payoff. So the traditional payoff for a long call option is going to be the maximum of stock price at that expiration date minus the strike price, or it would be zero. And the opposite would be the payoff for the short position, because whatever is the buyer's gain, the buyer's gain is the seller's loss and vice versa. So which means it is minus of maximum of st minus k comma 0, which actually works out as minimum of k minus st comma 0. That would be the payoff associated with a short call option. So you could see that it is a mirror reflection. So even if even if the premium is considered, I will take it as exactly a mirror reflection on the x-axis to that of the long call position. Similarly, when I look at the short long put position, if the market price is greater than the strike price, the holder of the put option, he will prefer selling it at the market price itself. Only when the market price goes below, he will try to sell it at the strike price itself, because he already has an option to sell it at a strike price. So that is where he is getting a gain, which is the difference between the strike price and the market price. So that is where we are saying the payoff associated with a long put option is the maximum of strike price minus the spot price comma 0. And if it is a short position, which is exactly the opposite of the long position, which comes out to minus maximum of k minus st comma 0, which will turn out to minimum of st minus k comma 0. So if I really look at a few more things, this party will expect the stock price to go up. A person who has taken long call will expect the stock price to go up. A person who has taken the long put will expect the stock price to go down in the future. So here it becomes opposite. A short call expects that it will go down, and short put will expect that the price of the option or the stock price or the price of the asset is going to go up in future. So for every option, you have a long position as well as a short. Long is who is taking the option, paying the premium to the other party, who has the option to either exercise or expire the option. Whereas the short is a person who has sold the option, for who is taking the premium and for whom it is obligation to perform in case the long position wants to exercise the contract. So writer of the option receives the upfront premium, but after that his liabilities could be unlimited. he has to act as per the action of the long position. So writer's profit or loss is always the reverse of the purchaser. So I can always look at the negative of the purchaser's profit or loss position and call it as the writer's loss or profit position. Now, looking at what kind of assets are on what kind of assets the option contracts are available. Today, stock options are there, very much traded on the exchanges, where we could see two major kinds of options, the American and the European. Different kinds of stocks are the underlyings. So each contract, it goes like this. If it is a call option, it gives the holder to right to buy. If it is a put option, it gives the holder right to sell X number of shares at a specified strike price in the future. Similarly, we can have foreign currency options, right? Most currency options today are traded over the counter itself, though we have a few exchanges on which they are traded, but majority of the trading in the foreign currency options goes in the over the counter market. And one contract is to buy or sell X units of foreign currency for a domestic currency. Then we are talking about index options, where the underlying is the stock index. Today they are traded both in the over the counter as well as on different kinds of exchanges. And because you can't deliver an underlying index, in most of the case, in all the cases, the settlement is always in cash, no delivery of the underlying portfolio index component. One major thing that we see as underlying today is options on futures. Almost every exchange which is selling a futures contract, we could see an option on futures, which means it is an option that is given to one party to decide whether he wants to go ahead with the futures contract in the future or not. So the life of the futures option ends a short period of time before the expiration of the trading in the underlying futures. So before the trading ends, there is this option is expiring. So to decide whether to go ahead with the futures contract or not is coming out as an exercise out of this futures option. So in case of call option, if I am exercising it, so I am looking at the gain as the futures price minus the strike price. Whereas in case of put option, when it is exercised, it's exactly the opposite for the holder. Strike price minus the futures price comes out as the gain for the holder. The negative, the opposite of that will go as the loss to the option writer. Now, looking at a few interesting specifications of the stock options that are listed on the exchange. So, just like futures, the entire details of the contract, right from the date on which it is expiring. Generally, again, the delivery month is what would be specified. The strike price, the differentiator is in futures, there is only one strike price or one price, one futures price, whereas in case of strike price, we can have many strike prices for one single security. What happens when the dividends are declared? How is the strike price adjusted? All these things has to be very clearly specified by the exchange. And what is the kind of position limits that are associated? How big a position can be held by each individual investor? They are all very clearly specified by the exchange. So when we talk about the expiration date, generally it talks about the expiration month, and the exact date again decided by the exchange. Some exchanges might talk about some specific date, like, or probably sometimes, okay, an Indian exchange like NSE talks about the last Thursday of the month. So in some exchanges it could be probably the 20th day. So the date could be very much decided by the exchange, right? When one option reaches expiration, automatically you are seeing that the next option is anyhow coming into the market. So the trading starts on the next one. Most of the times you find the options very short term. right? 1 month, 2 months, 3 months, very, very shorter term. 9 months could be slightly possible, but the longer term options typically called as leaps, typically on an average around 39 months, which are called as long term equity anticipation securities. They are traded on many stocks in the United States. So these are the options with an expiration date of almost 39 months. So there are a few such kind of instruments that are there, but by default, majority of the American and the European options that are listed on the various exchanges, they are very much short term in nature. Then coming to the strike price, generally the exchange chooses the strike prices with appropriate spacing. Probably it looks at a space of $5, $10, $2.50, some such kind of spacing, depending on what could be the typical stock price, right? Depending on in what range the stock price is, or what is the size of the stock price, how big is the stock price, the spacing is decided accordingly. And but yeah, we will talk about it slightly later. If there is a stock split or a stock dividend, the strike price could become slightly non-standard. It may so happen that I may have with a $1 spacing. In general, there may not be a $1 spacing, or probably $1.25 spacing. In general, that may not be the case, but because of the stock split or a stock dividend, that kind of a pricing had to come out. Now, any new expiration date coming up. So let's say now a new option is coming up for July 2015. Now, what the exchange will look at is, it will look at the today's stock price. Okay, it's around 100. Now, what it will do is, it will look at couple of strike prices which are closest to it. Let's say if the spacing is 5, it looks out for a couple of them somewhere in this kind of a range. So it will have 3 different options currently around in this kind of a price. So this is how it selects the different strike prices. Now if any time, let's say the stock price has already touched 107, then immediately it will introduce one more. $110 would be the strike price, or probably if the stock price has gone to 92, suddenly it will introduce 90 also as one more strike price. So if the stock price moves out of the range, right, defined by the high and the lowest strike price, now a new option, new strike price with a new option with a new strike price would be introduced by the exchange. So which means in any particular month, depending on the kind of fluctuation or the volatility that is associated with the price, different kinds of option contracts can be created with different strike prices. So many different option contracts may be trading. Out of that, just for a terminology to understand, when I talk about the option class, we will call them as calls and puts. Call is one option class, puts are one option class. And within them, we talk about a series. In a particular class, let's say in a call option, all call options of one particular class with the same expiration date and strike price, we are calling them as option series. So basically it is like one contract. So just as a terminology, we need to be aware of these two terms. Now, the moneyness of the option. For that, we talk about the option being in the money. When I say in the money, the probability of exercising the option is very, very high. And when it is at the money, the probability of exercising the option is probably called as 50-50. And there is a chance of expiry as well as exercise. But if it is out of money, the probability of exercising the option are very, very less. So that is when we call it as in the money, at the money, out of money. So when the stock price is greater than the strike price, the call option will become in the money, whereas the put option will become out of money. Because the chances of exercising the call option are much higher. Market price is already above the strike price. So I should be able to buy it at the strike price. I'll exercise the option. So the chances of exercising the option are much higher in case of call, but they become much sleeker in case of put. So the call option is said to be in the money when stock price is greater than the strike price, whereas the put option is said to be out of money. Similarly, when I talk about the stock price below the strike price, probably the put option becomes more and more attractive now, because I should be able to sell it at the strike price, sell the asset at the strike price. So the put becomes more and more in the money here, the call becomes out of money. But when the stock price is equal to the strike price, both either the call option or the put option, both of them, they become at the money. There are equal chances of exercise as well as expiry. And what we have to simply understand is the option would be exercised only when it is in the money. Of course, at the money also there is some probability of exercise, but to a large extent the option is exercised when it is in the money itself. And just as a terminology, every option is having an intrinsic value. Whenever we use the word intrinsic value, if at all the option is going to expire now, if at all the option is going to expire immediately, what is the value associated with that option? So no time to maturity at all. Immediately it is expiring. What is the value of the option? That is what we are calling as the intrinsic value. Easily put, it's the current price minus the strike price, or zero for a call. Strike price minus the current market price, or zero, whichever is the maximum in case of a put. And we'll see later that in the money American option, when I say American option, it can be exercised anytime. So in the money American option must be worth at least as much as its intrinsic value. And whenever we talk about the total value of the option, apart from the intrinsic value, we also add up the time value of money, because as the passage of time, because expiration date could be at some other date in the future, with the passage of time, some additional compensation is required for holding the option, and that is where we are adding up the time value of money also and bundling it as a part of the total value of the option. Apart from the regular options, nowadays some exchanges across the world are coming up with some flexible kind of an options, especially to regain the business from the OTC markets, where the traders are coming up with non-standard terms. The standard strike price will not be applicable there. Standard expiration date, the delivery month, and the specific date on that delivery month, those are not present as a part of these options. In some cases, even the option, probably if that exchange is traditionally dealing with American options, this flexible options could be European. So even that option structure also can comfortably change. And nowadays, a lot of innovation is happening on the exchanges with respect to various non-standard products. Some exchanges have introduced options on ETFs, just like the stock options. Even on the exchange traded funds, the options have been introduced. Instead of monthly options, we are talking about weekly options in some cases, where the option expires within a week. It starts in a particular week, ends by the next week. Then we are talking about binary option. Instead of the payoffs looking like max of ST minus K comma 0, the moment the strike price is crossed, the moment the strike price is reached, we are talking about a fixed payoff. Right? It's not the difference between the stock price and the strike price. The moment the strike price is reached, whether it is a call or a put, we are talking of a fixed payoff being done. Those are binary. Either you get the full money or nothing. There is no intermediate. So those are some kind of options very heavily traded in the OTC market, but nowadays some exchanges across the world are also trying to introduce these kind of products. Similarly, there are a few exchanges which are working with credit event binary options. So again, here also there is a fixed payoff that is paid, right? If a particular company suffers a credit event, like if a particular company goes bankrupt, or if it fails to pay the interest and principal whenever it falls due. So just like a credit default swap, but it is traded on the exchange, and it's a kind of an option where a lump sum is being paid based on a credit event of some company. Similarly, we have doom options which are called deep out of the money options. Now obviously, because they are deep out of the money, the chances of exercising those options are very, very limited, which means they will have, in case of put options, the strike prices are much, much, much lower. Only if the stock price goes even below them, then only they are going to be exercised. So the chance of exercising is much lower, which means the premium would be much lower. The cost of that option is much lower. It's only the major intention of a doom put option is in case there is a stock market crash altogether, the underlying asset dooms like anything, this option is going to provide a decent payoff. Then, as a part of some more specifications associated with the options, we are even looking at the dividend and the stock split. See, typically whenever we are talking about a cash dividend, we see that anytime company declares a cash dividend, the strike price is reduced by the amount of dividend on that X dividend date. So if there is a $2 dividend per share, so you will see that the strike price is going to be reduced by $2 on the date the dividend is announced. On the day that the dividend X dividend date, whichever is the cutoff date for the payment of the dividend. So exchange traded options, right? This should be the case. Whereas in the exchange traded options, we generally don't look at any kind of an adjustment for cash dividend, right? But on the exchange traded, we see some kind of adjustments for stock split. So which means if there is an N for M stock split, 3 for 1. So one share being split into 3 shares. So strike price, let's say earlier it was 60. Now suddenly it becomes 20 per share. The strike price will become 20, and the number of shares instead of number of contracts instead of number of shares in a contract, earlier if it was 100, now it will become 300. So it's a straightforward adjustment for stock split. For regular cash dividend, you don't find any kind of adjustment on the exchange traded option. Whereas on the over the counter, you find that parties will typically agree upon reducing the strike price by the amount of cash dividend that has been declared. Similarly, for stock dividends, also the same thing happens, because stock dividend is also virtually, I can look at it from the perspective of a stock split. And the same way, they are arising from a stock split. Look at this. Earlier, there is a put option to sell 100 shares of a company for $15 per share. Now, a company has declared 25% stock dividend. Now, it has declared 25% stock dividend means probably it's as good as 25% for each share, 25% additional shares are given. So for one share, 0.25 shares are given. So for every 4 shares, one new share is given. So it's actually like the price will become 4/5 of the original, which means the price is, the strike price is going to be 12 now, and the number of shares are becoming 5/4 of the original. So 100 is becoming 125. So now the new contract is one single contract will contain 125 shares, and the strike price is going to be $12 a share instead of 50. So what we have to really understand is a cash dividend is not impacting the strike price of the options, whereas a stock split or a stock dividend is definitely resulting in decrease in the strike price accordingly in that proportion, and increase in the number of shares per contract in the opposite proportion. Then every exchange, with respect to the number of options traded, there could be position limits as well as exercise limits. So the position limit with respect to the option is more talking about the number of contracts which the investor can hold on one side of the market. So one side is either towards the bullish kind of a market or bearish. On one side, the number of options. Why I am saying bullish and bearish? If an investor is expecting bullish, either he will go for long call or he will go for a short put. Similarly, if he is expecting bearish, he will go for a long put or short call. From the position limit computation perspective, both these positions are treated into one category. Both these are treated into other category. It's not calls and puts. Long call and short put are together treated as a group. Long put and short call are together treated as a group, because in both the cases the investor will assume the market will be bullish, whereas in these both the cases the investor will assume that it is going to be bearish. Now, coming on to the exercise limits, this talks about the maximum number of contracts that any one individual or any kind of company in any period of 5 business days, consecutive business days, how many contracts that it can really execute. Generally, this would be equaling the position limit itself. The main intention of any of these limits is make sure that by taking one side of the market, the investor is not unduly influencing the prices. A group of investors are not unduly influencing the prices. Now, coming on to the trading aspect, nowadays very rare you see an open outcry process, as in the futures also we have looked at. Majority of the cases, the trade derivatives exchange is fully electronic, so no need to physically meet. And majority of the option trading happens through market makers. And the market makers are the individuals who will give both a bid and an offer price. So we know that bid price is the price at which they are willing to buy, and the offer price is the price at which they are willing to sell the particular option. The major thing is they are providing both. So at least it is providing some kind of a confidence that at some price or the other, the buying and selling is going to happen without any kind of a delay, which means the market maker in a way is adding heavy liquidity to the market. But the only thing is, okay, they are quoting both of them. They are giving the buy price as well as the sell price, but they really don't know the trader who has asked them for these prices, whether he will be selling it to them or whether he will be buying it from them. The trader can take any kind of a position, because any of these people are ready to take either a buy position or a sell position. The trader can take the position of his choice, whether he wants to buy the option or sell the option. But just as a ballpark rule, we'll always see that the buy price will always be less than the sell price, because buy is the price at which the market maker is willing to buy the option. Sell is the price at which the market maker is willing to sell the option. Obviously, he wants to buy for a lesser price and sell at a higher price. And that difference is what we are calling as a bid offer spread. And the market maker is actually making a profit out of this bid offer spread itself. But this is where exchange also comes up. In order to make sure that this bid offer spread is not exorbitantly higher, the exchange can very well set some kind of limits on the maximum limits associated with this bid offer spread. And just like a futures position, the options position is also to a large extent offsetted much before the delivery and the position is closed out. So offsetting, we know it's a process where the purchase, if a person is a buyer, initially he has bought the options. Now he can do the sell operation for exactly same number of options for the same delivery date. Now this will negate one another, offset one another, and it's as good as the deal is closed. So if we are talking about let's say A and B who have got into an option contract, A is the buyer, B is the seller, right? Or A has taken a long call, right? A has taken a long call, so B is a short call. Now A can enter into one more position with C, where A could become a short call, C could be a long call. Or is the same thing could happen, B could have taken with the D. B could have taken with the D. B could have become a long call and D could have become a short call. Now you could see A has a long call as well as a short call, which means A is out. A has closed his position. B also has closed his position because he has a long call and a short call. Now what we are left with is C is having an open long call position. D is having an open short call position, right? So these are the things that are left. Now, if neither investor is closing an existing position, neither this person is going with a short call nor this person is going with a long call, the open interest is increased by 1 unit because this is the open interest. Now both of them are not. Now these two have got into a contract, neither of them have closed it. So the open interest has increased by 1. Whereas if after this has occurred, which means A is now out, it's like a deal between B and C. So the open interest does not change. Now along with this, let's say B has closed with C, not with the D. Let's say B has closed with C itself. Then all of them have closed their existing positions, which means the open interest is going to go down. So we are looking at open interest more in terms of number of long positions or number of short positions. Both of them have to be the same. Number of long positions or short positions which are outstanding, that is what we are calling as the open interest. As long as something is offsetted, the open interest is going to go down. Whereas if nothing is getting offsetted, the open interest is going to go up. Then coming to the margin requirements, generally majority of the options are short-term options, right? So wherever we are talking of a short-term option, the party who has taken a long position, in general, he is paying the full amount to the party who has gone for a short position. All the premium is paid upfront. Very rarely any kind of margin, borrowed kind of money is used for paying the premium, because already premium is a very small amount, and buying it on a margin is increasing the leverage even more drastic. Already there is a lot of leverage, because by having a small amount invested, there is a possibility of making a big gain. Now, if the leverage is, or if the margin is allowed, even with a very small amount, there is a possibility to trade or gamble on a big number. So, to a large extent, for very short term kind of options, there is no facility of margin buying, paying the premium to the party. Whereas in case of a longer term maturity option contracts, there in United States, there are possibilities of buying on margin at least up to 25% of the option value. Now coming to the writer, so from the buyer's perspective, there is no requirement for a margin account because there is a full amount that is paid from the buyer to the writer of the option. Now buyer is fully at a credit risk, but there is no risk from the writer's perspective because the buyer has completely paid the cash to the writer, and it's a full right that is given to the buyer to default. So margin wise there is no requirement from the buyer or the holder, but from the writer perspective it is mandatory that he maintains the funds in the margin account. In case of futures, both the buyer and the seller, both of them have to deposit. Whereas in case of option, it's only the seller of the option or the writer of the option who has to deposit the funds. The buyer of the option or the long position in the option, because he has paid the entire premium to the short position, he does not need to maintain any kind of a margin account. So the intention to collect the margin from the writer is to ensure that the trader will not default in case the option is exercised by the buyer. Now here we talk about another set of options which are the naked options. Naked options are not covered. Not covered is I don't have an offsetting position in the underlying stock. I'm taking a kind of a speculative position in the option. I don't have any kind of an offsetting position in the underlying stock. Now in this position, it is very much possible that the risk is going to be much higher. So this is where we are talking about writing off the naked option. The initial and the maintenance margins could be much higher. Different exchanges have different kinds of rules in terms of setting the margin requirements for different kinds of naked calls as well as puts. Now, one interesting application of options today in we find hundreds of applications of options in the traditional corporate finance world as well. Not just the options that are traded on the stocks and bonds on the exchange and the over the counter. We are seeing the features of the options being used in various dimensions like warrants, employee stock options, convertible bond. Almost all of them are going with the principle of options itself. Now, if I look at the warrants, the options that are issued by the financial institution or the non-financial corporation on its own stock. This is one thing. On its own stock, the options are issued, right? And it is like to exercise that warrant, it's not the exchange or the over the counter that needs to be contacted. The institution needs to be contacted for exercising the option. And generally it is packaged along with a bond. A company issues a bond, along with it, it is giving a kind of a warrant. Now what could very well happen if the company, so this warrant will be a kind of a right to buy the share of a company at a particular price. Now if you look at it, if the person wants to exercise this, he might very well sell off this bond. He might sell this bond, use this proceeds to typically purchase the share. Or he might sell this warrant itself separately into the market. So the issues here when we are talking about the warrant, it's on the own stock. You can very well buy the shares of our own company. So if you want, you continue it as a bond. Otherwise, you have an option where you can sell this bond, use the proceeds to purchase the share of the stock. So it is becoming more and more attractive to the investor because the investor can continue either with the bond or if the company is performing well, if the market price is going much above that strike price, then he can think of going ahead with the stock as well. Similarly, employee stock options. These are some kind of options that are given to the employees to motivate them, to make sure that they contribute to the share price, to make sure that whatever the activities they are doing are in the best interest of the shareholders. So they are giving some kind of an option to an employee which will contribute to the increasing of the stock price. So it's an option that is given to them to purchase the share of a company at a particular price X, at a strike price X. So if the market price is obviously greater than that X, the difference is what is giving them the profit in terms of compensation, which could add up to their compensation. So at the time of the issue, they are generally at the money. So anything that you are taking the share price above that, that additional is what is contributing as a kind of a remuneration to you at a future date. So that's again an application of option. We know convertible bonds, they are also a kind of option features where the bond can be converted into a stock at a certain time in future using a predetermined exchange ratio. So these are like callable bond. Some kind of embedded call option could be there on the company's stock. Now what we are seeing in all these in comparison with the options that are available in the market or on the exchanges, here first of all the predetermined number of options. In all these three cases, the company already decides how many options it wants to issue. Whereas when we look at the options that are there on the exchange, they are purely controlled by the demand and supply. So more and more on a day there could be more and more options. On the next day there could be a lot of option positions that could be closed. So if we look at the traditional exchange based option, we don't even know how many options are outstanding at any particular point in time. Whereas when we talk about these kind of options which are issued by the companies, these are not issued on the exchange. These are issued by the companies, and even the transaction happens with the companies directly. So based on the demand and supply, the exchange traded option numbers can change, but not these options. And when you look at any of these, when they are exercised, it is more new shares of a company that are getting created and they are being sold to the holder at that strike price. Whereas when we are talking about the exchange traded, it's not that new options, new stock, new shares are getting created in any way. No new shares are coming up in any way. All that is happening is a cash settlement based on the price movement of that underlying shares itself. No new shares are getting created there. So the company is no way directly involved with the number of options that are issued. Whereas when we are talking about warrants or employee stocks, new shares are issued by the company. So we have to clearly understand the difference between the traditional options that are present on the exchange versus the options that are issued by the companies in the form of warrants, ESOPs, convertibles, etc. And whatever we have looked at till now is the options that are traded on the various exchanges. But recently, for different kinds of products, we see the options traded over the counter also growing right from 1980s, and today it's much bigger than the exchange traded market. Options in the over the counter on different underlying securities has even grown past the exchange traded option market, especially on the foreign exchange and the interest rates. We see the options are very popular on the exchange, on the over the counter. But obviously, just like any with any OTC market transaction, there is a possibility of credit risk that is associated. The option writer may very much default. So for the purchaser's perspective, there could be a credit risk. And this is where nowadays there are different ways of handling these kind of counterparty risk, where we are talking about collaterals being posted. And The instruments that are typically structured to meet the precise, they are not standardized kind of products. Standardized means I could have very much used the service of exchange itself, because more and more customized, tweaking to the needs of the clients, the dates, the strike prices, the size of the contract, they are not standard in nature. Otherwise they could have chosen the exchange itself. And in some cases, even variety of the products today, we will, when we talk about exotic options, we'll see there are hundreds of variants of options, not the traditional American and the European put options and call option. We can have different varieties of the options that could be created, which are all coming under the category of exotic options. And all of those exotic options, they are not traded on the floors of the exchange. They are taking the route of the over the counter itself. Right, so this is what I wanted to cover as a part of this session. So just as a quick recap, we have looked at the different types of options, the calls and puts. We have looked at the positions, the long, short, call, put, different underlying assets that are going with the options, the different kinds of specifications associated with the stock options, the trading process, the role of the market makers, the margin, how it plays a role, who has to deposit. Towards the end, we just had a small understanding about the different kinds of options that are initiated by the companies, like warrants, ESOPs, convertibles. And towards the end, we just had a quick glance of options that are trading in over the counter markets. So that's it I wanted to offer as a part of this session. All right. Thank you very much.